Welcome everyone to another CreditorWatch webinar. We've got a fantastic session ahead of us, and I will invite Anita to join us, the ATO Assistant Commissioner, Frontline Risk and Strategy, Frontline Operations. Anita, great to have you along. Thank you for your time.
Thanks, Patrick. Good to be here.
Anything we ever do with the ATO is always extremely well attended, and this session is no different. I think we've got something like 900 plus registrations, lots of people still joining at the moment, so I'll do a nice go slow introduction and get into it so they don't miss too much. So of course, today we are talking about the ATO's current approach to debt and how to manage your obligations. ATO data from a credit risk management perspective, credit reporting, credit scoring is probably the most important piece of data that's come into credit reporting in the last 10 or 20 years. Extremely valuable from a risk perspective, a forecasting perspective. So grateful that it is available, and also really grateful to the ATO as well for their continued access to people like yourself, Anita, transparency around what you're doing over there. I think there's at least from my perspective and the feedback that I get from our customers, from the market, from stakeholders is it is sort of night and day in terms of the access that we now have to the ATO. So grateful for that, and I pass on my thanks from all the people that I speak to as well. So let's get into it. We've got some slides from CreditorWatch that I will take you through, touching on some of the data that we're seeing in the market, and then of course everyone will be hanging out to hear from you, Anita, as well. So let's kick off today's session and get into the slides. So just a reminder, CreditorWatch is a commercial credit reporting agency servicing 10,000 plus companies across Australia. We've been around for 15 years now. We've grown quite quickly, continue to grow quite fast. And ultimately what we're trying to achieve is to empower Australian businesses to trade confidently with their customers. Now that doesn't matter whether you're a small business, medium-sized business, or even the largest companies and banks in Australia. We've got companies of all sizes, all shapes, from all parts of Australia using us, which is really exciting. A huge focus for us at the moment is really growing our unique data set, and that comes from sourcing data from sources not yet being tapped into, but in particular trade payment, trade line information. How are businesses paying other businesses? How are they likely to pay you? What does that mean for their risk moving forward as well? And a huge amount of investment going into the platform too, investing about probably 22% of our revenue into R&D and innovation, and that will continue into the future as well. So we've got some really fantastic new features and products constantly being released, but some big, obviously, buzzword AI related ones coming in the next 6 months or so that I think we will start to speak about in upcoming webinars. Of course, a reminder in terms of data and where we're getting it from. Talk about common data sources, ASIC, ATO, Australian Business Register, courts, bankruptcy information from AFSA, and then on the left-hand side, our unique data. So that's data that is either being sourced by CreditorWatch from proprietary data sources or being shared with us by our customers. And of course, we've got coverage across all Australian businesses and companies, so all entities, including unincorporated entities, and I touch on that from a tax perspective as well. So that's sole traders, trusts, and partnerships. So what are we seeing in the market at the moment? Obviously, the last 5 years, it's hard to believe that the start of COVID was all the way back in 2020. Has seen a huge amount of movement, huge amount of pressure, both locally and also internationally, globally. And it's no secret that there's been a huge increase in the number of insolvencies, business failures and pressure on businesses, particularly small businesses. So what we're looking at here shows the business failure rate by CreditorWatch credit rating pool. So A being, a great business, E being, an insolvent or business company in administration. Typically what we find is, anything that's sitting up to, between A and C2 is a good quality viable business. The majority of businesses sort of sitting in C1 and C2. As you get into that C3 and below, we start to see deteriorating conditions and higher risk of failure of companies with those ratings. So this chart's really looking at failure rates, or showing that the failure rates for those businesses with ratings at the lower end, so sort of subprime and below that D1, D2, D3, D and E, really starting to be above those long-term averages, certainly well above where we were pre-COVID, if you can go all the way back to the left-hand side there through 2019. And while they remain high, and we expect them to remain elevated, we do believe that they have peaked. We've seen some really positive signs from a payment perspective, payment times perspective, defaults, insolvencies as well, and all of that comes together obviously into our credit rating, into our credit ratings that you're looking at now. So we do believe it has peaked. There's obviously going to be ongoing pressure for businesses. We're not going to see probably a steep decline in the way we saw the steep incline coming out of 23, but I think everyone should take note that we are past the hardest bit, which is positive, and it's only going to get easier from here, which is a really positive sign. Our chief economist does note that we still have these sort of geopolitical trade challenges and noise that creates uncertainty. We have seen an uptick recently in the unemployment rate, but we also have seen reduction in interest rates as well, and there's a fairly a strong expectation that there'll be at least one more this year as well. So that is really the place we find ourselves in at the moment from an Australian perspective. Plenty of good news there to be on the downward slope into easier economic and trading conditions, but certainly coming off a high base, unfortunately, and businesses still doing it really tough. I've probably talked about this. Business failure rates and insolvencies have largely reverted to the mean. We don't see downturn level insolvencies. We were certainly moving up into or heading towards that, but it hasn't continued to rise, which is good. Talk of recession has certainly almost died entirely, which is fantastic. If we dig into the detail a little bit further, there are certainly some hotspots. Hospitality continues to be in a world of pain, but the good thing is that can turn quite quickly off the back of improved trading conditions and interest rates coming off. All of a sudden, consumers in particular, and even businesses, have the confidence to go out and buy a beer, grab a schnitzel, go out for lunch a couple of times a week, buy 2 coffees instead of 1. So that's positive. Construction is recovering from a mild downturn. Going really specific, road transport, asset finance have seen significant elevated loss rates, and then borrowers with high interest unsecured non-bank lending have seen a 2 to 3 increase in loan defaults and business failures. So certainly one to keep an eye out for when you're ordering credit reports, to see any sort of signs of obviously hospitality, construction, high interest unsecured bank lending, etc. Definitely going to feed into the risk profile of that particular business. We talk about the number of ATO business disclosures that have taken place. This gives you a really good understanding that it was back in October 23 where it really launched, and has remained fairly consistent sort of once we got through that first sort of 6 months. consistent in terms of the number of new defaults being lodged, and of course those that are coming off. Anita, I might throw to you now to just provide everyone with a reminder of you know, how the process works in terms of those disclosures being disclosed to the likes of CreditorWatch.
Yeah, sure, Patrick. So I think probably what I just start off with is to say that it's certainly not our first action to take in terms of disclosing business tax debts to credit bureaus such as yourselves. It is the case, though, that we're pretty effective now in terms of making that decision where the various criteria have been met, and that is where businesses, so that an entity with an ABN has an amount of tax debt that is overdue by 90 days or more, and that tax debt has accumulated to at least $100,000, and also where there's no active complaints or disputes or anything like that in play. So these are debts that the taxpayer has agreed to pay. We certainly, before we would take an action to disclose to a credit reporting bureau, we do make sure that there's been previous attempts to make contact and engage with the taxpayer. So it's really important to ensure that you don't ignore or avoid that early contact. I know sometimes it can be easy to do, trying to pretend or hope it goes away. But as we'll show in terms of today's discussion as well, it's really around an escalation of actions that the ATO undertakes, and the best way to avoid those actions from escalating is actually not to ignore the earlier offers of support and assistance that the ATO would undertake. Probably another somewhat unique factor in terms of when the ATO does disclose business tax debts is where a taxpayer no longer meets that criteria. So if there is engagement with the ATO that occurs subsequent to the disclosure and or efforts are made to pay down those tax debts, we do actually remove those disclosures from your reports. So another incentive to not only hopefully prevent the disclosure in the first place by taking those actions, but also that there's still an opportunity to respond and engage after the disclosure. And that also has an enduring effect for the taxpayer. I might just end on the point of we also agree that it's incredibly important that the ATO does have the opportunity to disclose these debts to credit reporting bureaus. We see more and more that if a business owes money to the ATO, it's likely they owe other creditors as well. And really the intent and purpose for us of disclosure is to make sure that other businesses making other commercial decisions are informed by what they can see with regards to these disclosures, as well as all of the other information, obviously, you've just discussed, which is available in your reports.
Yeah, fantastic. Thank you for that. I've got a few more questions, but I know that you've got some slides to get through, and I'll remind those listening in that they can actually submit questions within the GoToWebinar control panel as well. And time pending, I'll cast my eyes over those and hopefully read a couple out for Anita to answer. One of the questions we get asked a lot is just the sort of distribution of the disclosures by entity type or business type. And I think it surprises a lot of people to note that there are plenty of individual sole traders, trusts, partnerships that are having them lodged as well. It certainly isn't just against companies or proprietary companies. So again, a reminder to those, you know, in the finance and credit risk world, of which I would say 99% of people who have signed in are, ensure that you are monitoring all of those customers. Don't just monitor your biggest company customers, ensure you're monitoring your sole traders, trusts and partnerships as well, and running reports on them to ensure you stay across these defaults that are being lodged by the ATO. We also know that there is you know, a really high correlation between a default being lodged and the failure of that particular entity over the next 12 months, certainly higher than probably any other you know, negative piece of information like a court action or payment default when lodged against an entity too. Here, and that leads nicely to this one. This is business closure rate given an ATO tax default. So if we use on the far left there, food and beverage services, what effectively we're seeing is almost a over 45% closure rate after a tax default has been lodged. The majority of that 30+% is insolvency. We then have strike off and deregistration often is the smaller point there. So that leads, it provides weight to that. Where you do see an ATO tax default against an entity, whether it is on a credit report that you see, or you may be monitoring a customer and receive an alert that a tax default has been lodged, it is really, really a powerful piece of information and quite serious. So please, in the same way that Anita says, don't bury your head in the sand if you owe the ATO. If you are dealing with a customer that has an ATO default, don't bury your head in the sand either. Certainly want to be taking action very quickly. Moving down the list, the sort of top 5 there: food and beverage services, accommodation, education and training, ag and manufacturing rounding out the top 5. But you can see all the way through to retail trade, which is probably number 6 from the right there, fairly consistent, sitting anywhere between sort of 40, sort of 35 and 40 odd percent of sort of failure rate or business closure rate when a tax default is lodged. So it just shows you that companies that get to this point are very unlikely to be able to continue to trade, or certainly at the very least represent a huge credit risk moving forward. All right, I know everyone's keen to hear from you, Anita, so I will pass over to you to take us through your slides, and I'll throw some questions in there as we go along.
Thanks, Patrick. So yeah, we just wanted to start with a little bit of introduction. I think, as you mentioned, we've been doing quite a bit of work over the last couple of years now in increasing the opportunity to have conversations such as this one, to be really transparent about our approach. And I think particularly over the last 12 to 18 months, the ATO has been really, really clear around wanting to recognise the expectations that we have of taxpayers, and also be clear on what taxpayers might expect of us. So many of you may have seen sort of variations of this before if you have attended any other conversations with the ATO, but most importantly, it's probably just a good opportunity to remind everyone that the ATO's role is to collect tax so that the government can deliver critical services to the community. So it is at the core of everything that we do, is to understand that our intent and purpose is to make sure that we are funding those critical services for everyone in the community. It is our job to make sure that means that people pay the right amount of tax, and that is to the benefit of all Australians. It's also a critical part of our role, particularly in the area of sort of managing payment and debt recovery processes, is to protect the Australian community and other creditors, including employees, to make sure that businesses don't get an unfair advantage over those who do the right thing. We have an incredibly excellent compliance rate within Australia. We're very, very lucky, especially in comparison to other international jurisdictions. Around about 90% of all taxes are paid on time and in full. So that's something that we really hold firm in terms of then what we do for those who don't do the right thing and pay their taxes on time. There's obviously some of those taxpayers that are making a deliberate choice with regards to the decisions around prioritising payment of tax, and equally there are others who don't have a choice and are really suffering from some difficult circumstances and need some extra support. So we really look to ensure that we balance our approach with consideration of the fact that different taxpayers may experience different circumstances, and our support and assistance really reflects that. The ATO recently revised our mission to make it a little bit clearer, both for ourselves and also for the general community. And it really is around making sure that we're working towards an Australia where every taxpayer meets their obligations. And that's because complying is easy, help is tailored, and deliberate non-compliance has really clear consequences. So I think you'll see that coming through as we talk through our approach as well. So if we move on to what that means in terms of our approach to payment, it continues to be a really clear focus for the ATO in managing payment and debt. We are very strong, as our payment on time sort of records present, on making sure that wherever possible we, in the first instance, prevent debt. So really what we want to make sure of is that we have a really strong commitment to lodging on time, which ensures that people know the circumstances they're in, they know the amount that they owe, and they can take the necessary steps to achieve that on time. That's actually a significant part of what we invest in the ATO, is taking those steps before the due date to prevent debt, and also really strongly encourage those taxpayers who may know in advance that they're going to have trouble paying what they owe to contact us early. And we've really shifted our approach over the last couple of years in particular to ensure that for those that do take those steps to contact us early, we really reserve a little bit more in terms of the application of those discretions and support and assistance for those taxpayers. So it's a really good incentive to reach out early. We do a lot in terms of leveraging with our partners and other stakeholders. So that includes a strong relationship and recognising the important role that tax practitioners play. So we work very closely with tax professionals, both to share information that they can use to support their clients, but also to listen and understand what they're experiencing in the conversations that they're having directly with taxpayers. That can help us improve our approach as well. I don't think it'll surprise anyone to note that sometimes a government agency of our size isn't necessarily fully engaged directly in the community as we should be. And so we think it's really important, and have really strongly, as I said, invested in that space as well, to really learn more from our stakeholders and other partners and advocates in the system as well. We have been really, really clear though that we have moved towards the application of faster consequences. So historically, whilst the ATO has always looked to use the full extent of the actions that are available to us in terms of managing debt and debt recovery, we have taken steps to ensure that that actually occurs a lot quicker. There's a couple of reasons for that. Firstly, we know that when we paused during COVID, which was the right thing to do at the time, we definitely saw a change in response and posture broadly from the community, and it made it a lot easier for those who were wondering what they pay first or how they prioritise where they pay, to ignore what would be owed to the tax office or in terms of unpaid taxes. And we also know that through a fairly generous approach in terms of remission of interest and penalties and things like that during that same period, there was very little reason for anyone to do anything but sort of delay and delay. So that has changed, and there's been a lot that we've provided to make that clear to the community. Of course, remissions and support and things like that are still available for those that genuinely need it and are experiencing circumstances that are outside of their control. But we are definitely moving a lot quicker towards ensuring that those consequences are clearly evident for those taxpayers. And we are seeing a shift in terms of, therefore, what taxpayers are deciding to do, which we think is a really positive thing. The other thing I would note, and perhaps it's relevant to the points you made earlier as well, Patrick, around what you see with disclosures and what happens after. We do know that the longer, particularly small businesses, wait to do something about their situation, the more they accumulate high levels of debt, the more they're unable to get back on track when you consider that they have to maintain their current and future obligations, as well as trying to recover from what's accumulated over a period of time. So the 90-day period is actually a really critical point, because if you think about a quarterly BAS cycle for a small business, it becomes very, very difficult to recover if you've already extended beyond a couple of those quarterly cycles to get back on track, make up for time lost and amounts that you've accumulated that are still overdue, and then maintain what's coming at you next. So that it's a really important thing from our perspective for those who need a bit more of a nudge to ensure that our actions are sort of aligned to that. Of course, and this is no change and hopefully no surprise to anyone, we also have a significant effort in terms of how we respond to fraudulent, non-compliant behaviours. we make no apologies for fully extending all of the powers that we have where we see evidence of fraud and more egregious or deliberate behaviour. And we've had a significant effort over the last 12 to 18 months in terms of ensuring that that is really, really clear to the community, and is very much an effective approach in terms of really wanting to make sure that we see those behaviours shift and change. But also, obviously, I think the community would expect that where people are taking those steps, that we are enforcing those actions to the full extent possible. So why are we doing it? Again, I think we've shared quite a bit around the size of the collectible debt book. I think it's actually important that we also recognise that total debt is now well above $100 billion. So collectible debt is really just the portion of the debt book that isn't in dispute, that isn't owed by a business that's going through any kind of insolvent or bankruptcy process, and that hasn't been put on hold by the ATO. So this is the portion of the debt book that we do undertake our actions on. You can see that over time it has continued to grow, and significantly when compared to pre-COVID sort of 2018, 2019 period. In good news, what we've seen in terms of the increase, particularly of our firmer and stronger actions over the last couple of years, we have seen the rate of growth slow. So that's been promising. Largely what we see now in terms of that growth is a fairly significant portion of that is as a result of the interest that is accruing on those debts that remain unpaid. The interest rates from the ATO are not low. We're not a cheap lender in terms of what that looks like as an accumulation over time. And so, yeah, we're really happy with how we're slowing the growth, but obviously still quite a bit to go in terms of the amount of debt that, if paid, could absolutely then be used in terms of funding those critical government services that we talked about before. You'll also note that we're still seeing the largest portion of that collectible debt. It is activity statement debt, so it is unpaid activity statement debt, largely GST, pay-as-you-go withholding, and a smaller amount which is unpaid super guarantee that should be paid for employees' future. We're still seeing small businesses as the predominant contributors to overall collectible debt, and which is why we do a lot of work with small businesses, small business industry and advocates as well, to look at what are the ways that we can ensure that wherever possible we are actively taking those steps to prevent debt in the first place. We see small businesses in particular, although some of those debts can be lower value debts, actually some of them can be quite high. And so from a small business perspective, it's incredibly difficult to recover from some of those much larger values of debt.
It's a question for me, and one that comes up. Is there a goal to get it to reduce, or is there an expectation that, you know, as the economy grows and obviously, you know, there's business activity and interest grows, that this will just continue to grow, you know, in line with how it has historically?
Yeah, look, it's a really good question. I think traditionally, as you've commented on and as you can see, it's not unusual for the debt book to grow. I think there's only been 1 year in quite a long time where we're actually able to reduce collectible debt, and that is because of interest. So the debt book and the way that that is managed, it is designed to grow. I think we'd love to see it come down a little bit, even though we expect that it will over time continue to increase. The amount of growth we would describe as a little bit out of pattern during COVID, and the opportunity is now, I suppose, for many of these taxpayers, if they were to recover and get back on track. That's really why the ATO has wanted to increase our focus on payment and debt recovery, to ensure that if we can get those businesses back on track, we do that as quickly as possible.
Yeah, okay. So no sort of hard targets or anything like that, at least that can be shared?
No, so no targets to share, Patrick. We do, obviously, and our annual report will come out shortly. We do have some performance measures that really give us a sense of the health of the debt book. One is the collectible debt ratio, which does look at the portion of collectible debt as compared to net tax collections, and that's a really good sort of proportionate view that we do have a look at, and that is a little bit higher than what we would like it to be, and the best way to get that ratio down is to get payment in the door, because that both increases net tax collections and reduces collectible debt. So that's the goal.
Yeah, okay, great. I'll jump to that next slide for you.
Thank you. So from a firmer actions perspective, and there's a number of actions that we may use where our earlier sort of interventions are not successful in engaging taxpayers. You'll see here that we have seen a significant increase. I'm sure many of you would be aware the use of direct penalty notices is a very effective tool from an ATO's perspective. It certainly does put directors on notice in terms of payment of company debt. It's also a really important tool to consider in terms of directors then being personally liable to pay those company debts. So it does really put the question on the director as to the solvency of their company. Garnishee notices have also increased significantly last financial year as compared to the previous financial years. I think it's really important to note we're still well below what were the numbers of Garnishees that were issuing pre-COVID. But I think in prior years we'd sort of got to around 3,000 odd, so the 15,000 is a considerable increase. Pre-COVID, in some years we would have got to around about 50,000 Garnishees. So still certainly working our way through the use of Garnishee notices. Again, we really reserve these for instances where we're not getting any other engagement from taxpayers, and we do make quite considered decisions with regards to when and if we would apply a Garnishee notice. It's certainly not something we would use where we identified instances where taxpayers actually needed more sort of financial support or experiencing vulnerable circumstances and things like that. So that's all considered in terms of the decisions that our staff make. And you'll see probably, I think, just a slowing in terms of the disclosure of business tax debts, 24,000 odd to 30 June 2025. Largely that is a result, and the previous graph would have shown, you know, we were really, when it was first introduced, wanting to make sure that we captured as many of the businesses that did fit the criteria for us to disclose. We're probably now seeing that we've caught up in terms of this is becoming a bit more of a normal process that we undertake. So it's not to suggest that we're needing to use it less in terms of the overall population, but we're probably more at a stage where those numbers are being maintained rather than sort of those stark ramping up, ramping down numbers. As I said,
sort of consistent sort of numbers that we're seeing now, possibly a slight reduction is what you're saying there.
Yeah, that's right. So there's no specific change in our approach to reduce the use of disclosures is what I would say. Probably just seeing that it's starting to kind of plateau in terms of the extent to which we're seeing taxpayers meet that criteria where we would undertake those actions. The other thing it might be interesting to note or important to note is that these actions are not we don't necessarily apply one or the other. So it is absolutely the case that the ATO may disclose a business tax debt and for a company debt also issue DPNs to directors. So the decisions with regards to the best approach to take are made by our staff based on the circumstances of the taxpayer, as I mentioned before. It's really incredibly important to consider how you engage with the ATO, because we do consider that engagement when we're making decisions around whether or not to move to a firmer or stronger action. So if we do see evidence of sort of deliberate avoidance, deliberate attempts to not engage with the ATO, that definitely comes into play when we're making our decisions of whether to use some of our sort of firmer and more consequential actions for taxpayers.
And would you be able to put a number on like the total number of businesses or companies that could have one lodged today? You know, if we think about we're in a regular cadence of lodging them, which is great to know, are there, you know, thousands, tens of thousands, hundreds of thousands of companies that effectively meet the criteria but obviously haven't been sort of worked through the system?
I don't know. I wouldn't have that number to hand, Patrick, but what I'd say is that we're fairly up to date. So there's not necessarily hundreds of thousands of businesses sitting waiting for us to take this action. We have got the process fairly well organised now in terms of really being able to effectively identify as soon as a business does meet the criteria, we would issue an intent to disclose. Now, obviously, depending again on what the business does in response to the intent notice, we may or may not proceed with disclosure, but we don't have a really considerable backlog because it has become a fairly normal part of our approach to ensure we disclose. And another reason for that, as I mentioned before, is because we are able to then remove that disclosure should the taxpayer engage. So it can often be the case that we see that for some businesses, they may ignore the phone call from the ATO, they may ignore the letter and the reminder and perhaps the firmer action warning letter that we send. And then it's not until we actually do something like a disclosure, like a Garnishee, those sorts of things that they really start to pay attention and respond to us. So that's not an uncommon outcome, which is you know, good in the context of there's an opportunity still for them to make those payments, engage and you know, improve the behaviour in the longer term. But obviously we'd prefer it if those engagements and activities occurred as a result of those earlier actions, as opposed to having to do a disclosure to get that response.
And just on some of the language there, and then particularly around removal. So correct me if I'm wrong, you have to remove the disclosure once that engagement and/or part payment has been made. That's something that's a bit of a sticking point for a lot of our customers. They obviously love the fact that the defaults get lodged, but then sort of scratch their head when they are removed. You know, I explain that, or we explain that. But great to sort of just hear it again from yourself as well. It's legislated, as I understand it.
That's right. So it's a legal requirement, and it essentially comes down to if the taxpayer no longer meets the criteria for disclosure. So that may occur if they pay the debt because they wouldn't have an amount of tax debt that's over $100,000. It may be if they engage with the ATO and/or lodge a complaint or take any further action with regards to engaging with the debt. And you're right, it is a legal requirement for us to remove those debts from the disclosure log as soon as we identify that that taxpayer no longer meets those criteria. Yeah, great, thank you. And there's a number of questions on that have come through. So I think you've effectively answered that. So thank you. I might just ask another question along those lines. What's the sort of process, or at what point does ATO move to winding up action? Again, it really depends on the circumstances of the taxpayer, but what I can say is that and this has been the case for many years. So first and foremost, whilst we've seen quite a significant increase in the overall insolvency rates, the ATO continues to be a minor initiator of all insolvencies. What I would say is that we absolutely recognise and acknowledge that the nature of even the use of our firmer actions, so direct penalty notices, garnishees, those sorts of things, they can absolutely trigger a response, if you like, from a business to make a decision and really have a look at their solvency of their business. And so they may self-initiate insolvency proceedings, even if the ATO doesn't undertake wind-up action. For the ATO, in 24-25, there were around about just over 17,000 wind-up and bankruptcy proceedings that we undertook. It would only be the case that we would do that in the instance that we saw no response from the business as a result, again, of those earlier actions and the use of any firmer actions. And certainly we do consider that it's an important step for us to take if we see no evidence that the business is really looking to take steps to avoid an ongoing accumulation of either tax debts and/or there is a further risk to others in terms of how that might be impacting other businesses as well. So again, there's no hard and fast rules for us as to, it's not a follow the bouncing ball sort of approach that we undertake, but it definitely is a consideration for us in terms of how well we've seen a taxpayer respond from the actions before the wind up, the risk that we would identify in terms of what would happen if the business was continuing to trade insolvent. And obviously, each of the steps that we take before are really those tests of solvency from our perspective, noting that that the definition of insolvency is that you can't pay what you owe. So in most instances, given the timeframes and things like that, there is enough time has passed for actions to have been taken if there was capacity for the business to do that.
Yeah, okay, great, thank you. I'll move on to this next one because I know there's plenty of questions coming through around SBRs as well.
Yeah, look, SBRs is definitely a topic of interest. We are aware in terms of how this is going. So as this graph shows, we've seen exponential growth in the last 12 months in terms of the use of small business restructuring. And really, many of your listeners would be aware, but small business restructuring was brought in as an alternative to other insolvency actions just after COVID. It's a formal restructuring mechanism. It is available to small businesses in financial distress, depending on the amounts that they owe. I think importantly, what we do want to share is that the ATO does ensure that we are as active as we can be in terms of conversations with businesses who are considering small business restructuring. It's important to note that once a small business puts in an application for an SBR, whether or not it's approved or not, they can't just do it again the next year. So what we try and do is help small businesses before they submit their application to consider all of the information that they would be putting in their submission, because for a small business perhaps who isn't sure what to include, it may be rejected, and that does put them in a position where there's a number of years before which they could submit it again. It does speak to what are some fairly high acceptance rates from the ATO. So unlike ordinary insolvency processes, the voting for SBRs is determined by the creditor who's owed the most. And often in these cases, that is the ATO, which is different to ordinary insolvency approaches where the ATO has the same, we're all in it together. The ATO does hold a little bit more weight in terms of that voting process, just on the basis of the value of tax debts can be the most significant debt that a small business may have. Obviously, if we're not, then that would be different. We are really keen to see, and we'll continue to do some work on what happens after small business restructures. We obviously recognise that the intent and purpose of an SBR is that it really does give the business an opportunity to continue to trade. It does give them some immediate relief, and we're also very conscious of the fact that whilst this is lots of benefits for these small businesses, there's also obviously a lot of small businesses who are continuing to comply and meet those needs. So it's an important balancing process for us. We do give some advice, and we have recently improved the information on our website about what to consider when small businesses are considering SBRs, including making sure that, you know, really your finances are well and truly aligned with the intent of an SBR. That doesn't include sort of using things for your own personal use and things like that. And so in some instances, we're definitely seeing SBRs being rejected as a result of some of those sorts of behaviours. So it's not to be taken lightly, has some great benefits, but certainly is something that if we can support those small businesses as they're going through that process, then we will undertake to do that.
Yeah, that's great. Thank you. And I think, you know, you sort of touched on it. The SBR is still very new. Like, yes, it has been around for a few years, but I don't necessarily think we've found the baseline in terms of the numbers. You can see obviously a huge increase over the last couple of years, but it's coming off an extremely low base. It will be interesting to see where it ends up settling, particularly as we move out of this high insolvency sort of era for Australian companies, you know, a year or two from now, where it ultimately ends up settling. Do you have any sort of thoughts on that?
No, I think, as you say, Patrick, a bit too early to say. So yeah, it'll be certainly something that we'll continue to watch for, and yeah, it'll be interesting to see where it lands. Yeah,
great. A couple more questions. Really good engagement at the moment. How do you see you know, sort of tax defaults, small business restructures, and then, you know, Phoenix activity? Phoenix activity is something that comes up, you know, quite a lot. Do you see, you know, tax defaults starting off there as being, you know, a good mechanism to combat that, or does the ATO take a, you know, sort of separate approach to Phoenix activity?
So we certainly invest quite a bit in terms of combating phoenixing activity. I would say that the ATO looks for all evidence wherever we can, both in terms of current but emerging risks of that sort of behaviour. So right now, in terms of being as transparent as we can be, noting that we do work within some very strict provisions within the law that mean we often can't talk about individual cases. I think something like disclosure just gives us an opportunity to be a little bit more transparent for those who would be looking to engage with businesses. We do, though, always keep in mind the balance in terms of our actions and what that may lead to in terms of those taxpayers who may be more likely to undertake some of those deliberate behaviours such as phoenixing. So it's not on its own necessarily something we see a direct link on, but it's certainly the case that we would look for all of those emerging risks and really just see whether or not we're seeing any changes. But there's probably nothing at the moment that I would highlight as a specific link between phoenixing and disclosure in either direction.
Yeah, okay, thank you. Just with SBRs, we've seen an increase, a couple of comments here in sort of, you know, this pre-insolvency advisors or advisors to assist with, you know, SBRs. Is that something the ATO has taken note of as well?
Yes, yep, definitely. So very similar to any practice, I suppose, is we've always got an eye on what we're seeing in terms of what may present as perhaps not the full intent of certain legislation and avenues that businesses may have. And I would say, to be fair to say, we are also getting more sophisticated in our approach in terms of reviewing plans as well.
Yeah, you know, there's comments that get made that, you know, we've seen that reduction in, you know, SBRs as a result of, you know, the ATO sort of pushing back against those sort of insolvency advisors or pre-insolvency advisors. So it'd be interesting to see how those stats will look over the the next 6 to 12 months, and whether there's a correlation there.
Yeah, definitely the case that it's probably a combination of two things that we're seeing. One, as I said, is we are getting much more sophisticated in terms of our review process, but also we are seeing whether or not that's as a result of sort of different industries setting up the approach, but we're just simply seeing lower quality plans as well. So it certainly is a combination of the two.
Yeah. Look, at the end of the day, for all the taxpayers out there, we want to see the ATO get as close to 100 cents in the dollar. So that's I think there's certainly widespread support for that. We don't want to see or hear of companies that are neglecting their obligations and feeling they can get away with it through this SBR process itself. All right, I'm going to go to the next one. I think we've got through most of the questions. The poll question that we will pop up, which is more about CreditorWatch. Before we wrap up, I think all the sort of questions have pretty well been answered, which is good to see. Anita, I really appreciate your time. I know a lot of time and effort goes into not only the slides, but the content itself in terms of what you're going to present. The transparency, as I said, is really appreciated by myself, and I know our extensive customer base, subscriber base, loves to sign in and listen and hear from the ATO. So I appreciate that. Are there any ATO plugs you would like to make? I know that if you think about the thousands of companies that use CreditorWatch, in terms of the network effect, their customer base probably takes us into the millions of businesses. They're constantly dealing with businesses that will be in distress or are struggling from a cash flow perspective. It could be a short-term pinch. It could be a longer-term fundamental issue. Where should my customers, our customers, CreditorWatch customers, be sending their own customers for that assistance, so they're not burying their head in the sand and ultimately ending up with a tax disclosure against them?
Yeah, thanks, Patrick. So a couple of quick things to note. Firstly, just as a bit of a plug, I do want to confirm that the ATO is releasing its vulnerability framework, and it will be out this week. So a lot of great information that has come from quite a considered and wide-ranging approach with industry experts and advocates as well. So that will start to really reinforce the ATO's approach and consideration of taxpayers who are experiencing more vulnerable circumstances. It will also include some information with regards to some more practical steps that the ATO is continuing to invest in to make sure that we get that right as best we can. In terms of the channeling of information, obviously the ATO is available for those who need support, and we are investing. I think we've got now over 100 staff who are in our specialised support team, which are specifically there to consider those in more vulnerable circumstances. We've got our Indigenous helpline and also our advocacy help desk as well. Of course, the continued work, and we partner strongly with financial counsellors, the national tax clinics, tax professionals. There's a range of opportunities out there for people who are seeking support, and wherever possible, we're working closely with those representatives to share our information, and as I mentioned at the start, to really listen and understand those experiences so we can embed them in our processes as well. So a really exciting week from our perspective in terms of the release of the framework, and yeah, lots of renewed information and refreshed detail on our website following feedback from taxpayers to hopefully make it easier and more available for those taxpayers who need that support.
Awesome, that's great to hear, thank you. And then a plug of my own, of course, we released a new monthly release called our Business Risk Monitor, a pumped up version of our business risk index that had been around for probably 4 years that we developed during COVID. So for those who want to subscribe, do your thing with your camera and the QR code, or you can go onto creditorwatch.com.au and head to the news hub to access the information that's published on a monthly basis. We will wrap it up there. I think we're right on time. So Anita, again, thank you very much for taking the time. It was great to have you as part of this, as always. And I wish you all the best for the future, and hopefully get to chat to you again in the future.
Thank you. Have a great day.
Thank you. See you later.